and we are going to read through about 6 pages of the textbook, and then I'm going to show you a little video, and then we'll do 2 more pages, another video, and then you guys will answer some questions. All right? So here we go. Get some of this stuff out of the way. So let's pick up where we left off. We left off at page 625. That's where you should have read up to last Thursday or yesterday. So let's get into this. The Federal Reserve System. Okay. Whenever an economy uses a system of fiat money, as the U.S. economy does, some agency must be responsible for regulating the system. In the United States, that agency is called the Federal Reserve, often simply called the Fed. If you look at the top of a dollar bill, you'll see that it says a Federal Reserve note. The Fed is an example of a central bank, an institution designed to oversee the banking system and regulate the quantity of money in the economy. Other major central banks around the world include the Bank of England, the Bank of Japan, and the European Central Bank. All right, and again, please stop me if I'm going too fast. The Federal Reserve was created in 1913 after a series of bank failures in 1907 convinced Congress that the United States needed a central bank to ensure the health of the nation's banking system. Today, the Fed is run by its Board of Governors, which has 7 members appointed by the President and confirmed by the Senate. The governors have 14-year terms. Just like federal judges are given lifetime appointments to insulate them from politics, Fed governors are given long terms to give them independence from short-term political pressures when they make their monetary policy. Among the 7 members of the Board of Governors, the most important is the chairman. The chairman directs the Fed staff, presides over board meetings, and testifies regularly about Fed policy in front of congressional committees. The president appoints the chairman to a 4-year term. When this book was written, the chairman was Ben Bernanke, who was an economics professor appointed by President George W. Bush in 2005 and reappointed by Barack Obama in 2009. Part of your questions today, you're going to look up who's the current chairman of the Federal Reserve Bank. The Federal Reserve System is made up of the Federal Reserve Board in Washington, D.C., and 12 regional Federal Reserve banks located in major cities around the country. And as you may know, there's one of them in Boston. One of the 12 Federal Reserve banks is here in Boston. You can see it from any tall building. The presidents of the regional banks are chosen by each bank's board of directors, whose members are typically drawn from the region's banking and business community. The Fed has 2 jobs, and they're related. The first job is to regulate banks and ensure the health of the banking system so that people like you and I can trust that we can put money in our bank and get it back later. This task is largely the responsibility of the regional Federal Reserve banks. In particular, the Fed monitors each bank's financial condition and facilitates bank transactions by clearing checks. It also acts as a bank's bank. That is, the Fed makes loans to banks when banks themselves want to borrow. When financially troubled banks find themselves short of cash, the Fed acts as a lender of last resort, a lender to those who cannot borrow anywhere else to keep stability in the overall banking system. All right? The Fed's second and more important job is to control the quantity of money that's made available in the economy, which is called the money supply. Decisions by policymakers concerning the money supply constitute monetary policy. And at the Federal Reserve, monetary policy is made by the Federal Open Market Committee, FOMC. And this committee meets every 6 weeks, roughly, in Washington, D.C., to discuss the condition of the economy and consider changes in monetary policy. The Federal Open Market Committee is made up of the 7 members of the Board of Governors and 5 of the 12 regional bank presidents. All 12 regional presidents attend each meeting, but only 5 get to vote. And the 5 with voting rights rotates, except for one exception. The president of the New York Federal Reserve Bank always gets a vote, because New York is the traditional financial center of the U.S. economy, and because all Fed purchases and sales of government bonds are conducted at the New York Fed's trading desk. Through the decisions of the FOMC, the Fed has the power to increase or decrease the number of dollars in the economy, and you're going to see that's a big deal. In simple metaphorical terms, you can imagine the Fed printing dollar bills and dropping them around the country by helicopter, which is the picture you see on the front page of this chapter. Similarly, you can imagine the Fed using a giant vacuum cleaner to suck dollar bills out of people's wallets. Although in practice, the Fed's methods for changing the money supply are more complex and subtle than this, the helicopter vacuum metaphor is a good first step to understanding the meaning of monetary policy. So one of their big functions is to increase the amount of money circulating out there and to decrease it. Later in this chapter, we'll discuss how the Fed actually changes the money supply, but it's worth noting here that the Fed's primary tool is the open market operation. Buying and selling U.S. government bonds is how they increase and decrease the money supply. Recall that a U.S. government bond is a certificate of indebtedness of the federal government. If you buy a bond, they owe you money. If the FOMC decides to increase the money supply, the Fed creates dollars and uses them to buy government bonds from the public in the nation's bond market. So the government, the Federal Reserve Bank, will buy bonds, and that's how they'll put dollars back into circulation. After the purchase, these dollars are now in the hands of the public. Thus, an open market purchase of bonds by the Fed increases the money supply. Conversely, if they want to decrease the money supply, they'll sell bonds to the public. So the public gives the Fed money, and then that money's out of circulation. All right, so an open market sale of bonds decreases the money supply. All right, central banks are important institutions because changes in the money supply can profoundly affect the economy. One of the 10 principles of economics is that prices rise when the government prints too much money. So if the government prints too much money, we have inflation. All right, another is that there's a short-run trade-off between inflation and unemployment. All right, so if you try to combat inflation, you end up with more unemployment. You try to combat unemployment, you end up with more inflation, at least in the short run. The power of the Fed rests on these principles. For reasons we'll discuss more fully in the coming chapters, the Fed's policy decisions have an important influence on the economy's rate of inflation in the long run and the economy's employment and production in the short run. Indeed, the chairman of the Federal Reserve has been called the second most powerful person in the United States. All right? This is some important stuff, and a lot of stuff in this chapters will help you understand a lot of news that you hear day to day. All right? Banks and the money supply. Here's where it gets a little heavy. All right? So bear with me, and again, let me know if I'm going too fast. So far, we've introduced the concept of money and discussed how the Federal Reserve controls the supply of money by buying and selling government bonds in the open market operations. Although this explanation of the money supply is correct, it's not complete. In particular, it omits the central role that banks play in the monetary system. It's not just up to the Federal Reserve, it's up to banks as well. Recall that the amount of money you hold includes both currency, the bills in your wallet and the coins in your pocket, and demand deposits. The balance in your checking account counts towards the nation's money supply. All right, because demand deposits are held in banks, the behavior of banks can influence the quantity of demand deposits in the economy and therefore the money supply. This section examines how banks affect the money supply and in doing so, how they complicate the Fed's job of controlling the money supply. All right, so the smaller banks kind of complicate the Federal Reserve Bank's job, and you'll see why in a minute. All right, the simple case of 100% reserve banking. To see how banks influence the money supply, let's first imagine a world without any banks at all. In this simple world, currency is the only form of money. So cash is it. There's no checking accounts. To be concrete, let's suppose that the total quantity of currency is $100. So the supply of money, therefore, is $100. That is important. All right. Now suppose that someone opens a bank appropriately called First National Bank. First National Bank is only a depository institution. That is, it accepts deposits but does not make loans. The purpose of the bank is to give depositors a safe place to keep their money. Whenever a person deposits money, the bank keeps the money in its vault until the depositor withdraws it, writes a check, or uses a debit card to access his or her balance. So you put money in, you can take it out whenever you want. The bank does nothing with it except keep it for you. Deposits that banks have received but have not loaned out are called reserves. Money that's actually on hand in the bank, those are the bank's reserves. In this imaginary economy, all deposits are held as reserves, so this system is called 100% reserve banking. We can express the financial position of First National Bank with a T account, which is a simplified accounting statement that shows changes in a bank's assets and liabilities. Here's the T account for First National Bank if the economy's entire $100 of money is deposited in the bank. They have $100 in reserves and $100 in liabilities, meaning you can demand it from the bank at any time. That's what they are obligated to pay if people want to come collect their money. On the left side of the account, the T account, are the bank's assets, the reserves that are in its vaults. On the right side are the bank's liabilities, the amount it owes to its depositors. Because the assets and liabilities of First National Bank exactly balance, this accounting statement is sometimes called a balance sheet. All right? Now consider the money supply in this imaginary economy. Before First National Bank opens, hey, if one of you guys could you mute your computer, whoever's unmuted, because I can hear myself twice. Thanks. All right. Now consider who's not unmuted, guys? Is somebody? There we go. All right. All right. Okay. All right. Now consider the money supply in this imaginary economy. Before First National Bank opens, the money supply is the $100 of currency that people are holding. After the bank opens and people deposit their currency, the money supply is the $100 of demand deposits. There's no longer any currency outstanding, for it's all in the bank vault. Each deposit in the bank reduces currency and raises demand deposits by the exact same amount, leaving the money supply unchanged. All right? So it's either currency or it's a demand deposit. All right? If it's in the bank, it's a demand deposit. You can take it out at any time. If it's in your hands, it's currency. All right? So if banks hold all deposits and reserves, banks don't influence the supply of money. The supply of money is constant. All right? But here's what really happens. Money creation with fractional reserve banking. And again, this is a heavy idea. Eventually, the bankers at First National Bank may start to reconsider their policy of 100% reserve banking. Leaving all that money idle in their vaults seems unnecessary. Why not lend some of it out and earn a profit by charging interest on the loans? Families buying houses firms building new factories, and students paying for college would all be happy to pay interest to borrow some of that money for a while. First National Bank has to keep some reserves so that currency is available if depositors want to make withdrawals. But if the flow of new deposits is roughly the same as the flow of withdrawals, First National needs to only keep a fraction of its deposits in reserves. So First National adopts a system called fractional reserve banking. In other words, if people deposit money in this bank and they're not constantly demanding all of it back, if you've got money sitting in your reserves, you can start to loan it out to people. So you're not actually holding all of everybody's money at any one time. All right? The fraction of total deposits that a bank holds as reserves is called the reserve ratio. This ratio is determined by a combination of government regulation and bank policy. As we'll discuss more fully later in the chapter, the Fed sets a minimum amount of reserves that banks must hold, called the reserve requirement. In addition, banks may hold reserves above the legal minimum, called excess reserves, so they can be more confident they will not run short of cash. For our purpose here, we're going to take the reserve ratio as given to examine how fractional reserve banking influences the money supply. All right? Let's suppose that First National has a reserve ratio of 1 to 10, or 10%. This means that it keeps 10% of its deposits in reserve and it loans out the rest. So if people deposit $100 in this bank, it keeps $10 on site in the vault, but it loans out $90. All right? First National still has $100 in liabilities because making the loans didn't alter the bank's obligation to its depositors. So it still has an obligation to the people that deposited money to give back that $100 if people want to come take it out. But now it has loans of $90. And those loans become liabilities to the people borrowing from the bank. But they're assets of the bank, making the loans the bank that makes the loans, because the borrowers are going to pay back the bank. And plus, they'll pay back the bank with interest. In total, First National's assets still equal its liabilities. All right? It doesn't have this $90 on site anymore. It loaned it out, but it's still an asset because it can collect. All right? Once again, consider the supply of money in the economy. Before First National makes any loans, the money supply is the $100 of deposits in the bank. Yet when First National makes these loans, the money supply increases. The depositors still have demand deposits totaling $100, but now the borrowers hold $90 in currency. So even though we didn't create any new money, this counts now as $190 of currency, or of money supply. All right, it's the currency that's out there plus the demand deposits. That's the $90 that's loaned back out to the public, plus the $100 that's guaranteed to be paid back if people want to come collect it. So when banks hold only a fraction of deposits in reserve, they create money. At first, this creation of money by fractional reserve banking may seem too good to be true. It appears the bank has created money out of thin air. To make this creation of money seem less miraculous, note that when First National Bank loans out some of its reserves and creates money, it does not create any wealth. Loans from First National give the borrowers some currency and the ability to buy goods and services. Yet those borrowers are taking on debts, so the loans don't make them any richer because they're going to have to pay it back. In other words, as a bank creates the asset of money, it also creates a corresponding liability for those who borrowed the created money. At the end of this process of money creation, the economy is more liquid in the sense that there's more of the medium of exchange, but the economy is no wealthier than before. All right, and here's the heaviest idea of all, the money multiplier. The creation of money does not stop with First National Bank. Suppose the borrower from First National uses the $90 to buy something from someone, and then that someone deposits the $90 in a second bank, Second National Bank. Here's the T account for Second National Bank. So the first bank lent Joe $90. Joe bought something from Fred for $90. Fred puts the $90 in Second National Bank. Second National Bank has the $90. It's got liabilities of $90, but according to the 10% rule, it keeps $9 in its vault and it loans out $81 to other people. So if Second National Bank also has a reserve ratio of 10%, it keeps $9 in reserve and makes $81 in new loans. In this way, Second National Bank creates an additional $81 of money. If this $81 is eventually deposited in Third National Bank, which also has a reserve ratio of 10%, this bank gets a deposit of $81. It keeps $8.10 in its vault, and it makes new loans of $72.90. So we've created $72.90 in new money. The process goes on and on. Each time the money is deposited and a bank loan is made, more money is created. How much money is eventually created? We add it up like this: 100 plus 90 plus 81 plus 72.90, and the amount goes down. And those of you that have studied, infinite series in math know there's a limit to this. And mathematically, the limit is $1,000. If banks are required to keep 10% of your money in reserve, it creates 10 times the amount of money in the economy. That's called the money multiplier. It turns out that even though this process of money creation can continue forever, it does not create an infinite amount of money. If you laboriously add the infinite sequence of numbers in the preceding example, you find the $100 of reserves generates $1,000 of money. The amount of money the banking system generates with each dollar of reserves is called the money multiplier. In this imaginary economy, where the $100 of reserves generates $1,000 of money, the money multiplier is 10. What determines the size of the money multiplier? It turns out that the answer is simple. It's the reciprocal of the reserve ratio. If R is the reserve ratio for all banks in the economy, then each dollar of reserves generates 1 over R dollars of money. In other words, if the reserve ratio is keeping 1/10 of your money on hand, that creates 1 over 1/10, or 10 times as much money in the economy. Every dollar gets multiplied by 10. All right? So if the bank holds $1,000 in deposits, then a reserve ratio of 10% means the bank must hold $100 in reserve. The money multiplier just turns this idea around. If the banking system holds a total of $100 in reserves, it can have only $1,000 in deposits. In other words, if R is the ratio of reserves to deposits, then the ratio of deposits to reserves is 1 over R. All right? This formula shows how the amount of money banks create depends on the reserve ratio. If the reserve ratio were 5% or 1/20th, then the banking system would have 20 times as much in deposits as in reserves, implying a money multiplier of 20. Each dollar of reserves would generate $20 of money that's out there in the economy. Similarly, if the reserve ratio were 1/4, the money multiplier would be 4. All right? And if the reserve ratio is 1, if they're keeping 100% of your deposits on site, then the money multiplier is 1 and we don't create money. All right, I'm going to stop here and play you a video that discusses what we just talked about, and then we'll finish up the last 2 pages of the chapter, okay?
I would definitely recommend a Cheat to a colleague. I think it's a wonderful learning tool and an environment. And I love how everything is really there and it's prepared.
Get that?
Hey, how you doing? Econ students, this is Mr. Clifford. Welcome to Econ Movies. Right now we're going to talk about monetary policy by looking at the movie Despicable Me.
Hello, everybody. All right. Simmer down.
Monetary policy is when a central bank or other regulatory agency changes the
Hold
money
on one
supply
sec,
to
guys.
achieve specific economic objectives.
I think I want to play the other video first. Hold on. Hold on. Yep, here we go. This is the one. Okay. I'm gonna watch this one first.
Hey, how you doing, Econ students? This is Mr. Clifford. Welcome to ACDC Econ. Right now we're going to talk about how banks create money out of thin air. Whoa! You heard me right. Banks create money out of thin air. To explain how this is possible, let's talk about what a bank does. A bank accepts deposits from its customers, but it doesn't just hold that money. If all banks did was hold other people's money, there'd be no profit in that. Instead, what a bank does, it takes that money and it loans most of it out. Now, why can't it loan all of it out? Well, because sometimes customers come back and they want to withdraw some of that money. So if you and I and everybody else goes to the bank at the same time to get our money out, the bank does not have that money. They wouldn't be able to pay us, and the bank would default. Now, that's called a bank run, and it's bad, really bad. Now, in the United States, we have deposit insurance to make sure bank runs like that don't happen. But the point is, the bank doesn't hold all those deposits. They loan it out. Now, the amount of deposits that the bank needs to hold by law is called a required reserve. In the United States, it's 10%. This means that the other 90% is something called excess reserves, and they're free to loan that out. It'll make a whole lot more sense with an example. Let's say someone goes into a bank and deposits $100 from their pocket into the bank. Now, this won't change the money supply because money from your pocket is part of money supply, and so is demand deposits inside banks. So far, there's been no change to the money supply. But here's where the magic happens. The bank is going to hold a certain percentage by law, let's say 10%, so they're going to hold $10. That means they're going to loan the other 90 out. Now, the person who deposited $100 has $100 in the bank. But the person who borrowed the 90 also has now $90. That $90 is money that was created from thin air that did not exist until the loan occurred. Now that person's going to spend that $90, and eventually that $90 is going to make its way back into another bank. That other bank is going to take that $90. It's going to hold 10% in required reserves. So $9 is going to hold, and it's going to loan the other 81 out. That 81 new dollars is new money supply. It was not created until the loan occurred. Now, eventually, the person who borrowed the money is going to take it and spend it, and that's going to make its way to a new bank. And the same thing's going to happen again and again, and again and again and again. Now, it turns out that the initial deposit of $100 is actually going to become $900 of new money created. The way I got this is by looking at something called the money multiplier, which is 1 over the reserve ratio. So in this case, when the reserve ratio is 10%, that meant the money multiplier is 1 over 0.1, so it's 10. Now you might be asking yourself, if the initial amount deposited was $100 and the multiplier is 10, why didn't $1,000 of new money get created? The reason why is because the initial $100 was actually part of the money supply to start off with. So the only amount of new money that was created was from the initial loan of $90. And so $90 times 10 is $900 of new money created from the initial loan. And this is the whole idea of fractional reserve banking. Banks hold a portion of deposits and they loan the rest out. And whenever they loan it out, they create new money. Did you get that? Here, let me ask you a question to see if you actually fully understand that concept. Let's assume instead that the reserve requirement is 20% and someone deposits $500 into their bank. From their pocket, in the bank, $500. Assuming that banks loan out all of their excess reserves and there's no other leakages, how much would be the increase in the money supply? Well, the money multiplier is 1 over 0.2, and its multiplier is 5. That bank is going to hold $100 in required reserves, and their excess reserves of $400 they're going to loan out. That $400 is all new money, and all the other steps cause new money. And so it's 400 times 5, which is $2,000. Now, don't confuse
Patrick, you still with us there?
skipping that first round with the same idea of the Fed buying bonds. For example, if the Fed bought $500 worth of bonds, so the Fed buys bonds and puts $500 in the system, that whole $500 is new money. So in that situation, the new money created would be 500 times 5, which would be 2,500. Now, this is tricky, but it's just like the spending multiplier that you learned back when you learned fiscal policy. Make sure to take a look at my other videos and my review apps for the AP Economics test. Until next time.
All right. Let's finish this up. All right. Let's get back to the book, and then one more video, and then we'll see if we have time for some questions or not. All right. Let's see. All right. Bank capital, leverage, and the financial crisis of 2008 to 2009. 2 more pages here, guys. In the previous sections, we've seen a very simplified explanation of how banks work. The reality of modern banking, however, is a bit more complicated, and this complex reality played a leading role in the financial crisis of 2008 and 2009. Before looking at that crisis, we need to learn a bit more about how banks actually function. In the bank balance sheets you've seen so far, a bank accepts deposits and uses those deposits either to make loans or hold reserves. More realistically, a bank gets financial resources not only from accepting deposits, but also, like other companies, from issuing equity and debt. The resources that a bank obtains from issuing equity to its owners are called bank capital. A bank uses these financial resources in various ways to generate profit for its owners. It not only makes loans and holds reserves, but it also buys financial securities such as stocks and bonds. So banks are buying stocks and bonds with your money and making a profit. All right. So here's a more realistic T account sheet here. On the right side of this balance sheet are the bank's liabilities and capital. All right, also known as owner's equity. The bank obtained $50 of resources from its owners. All right. It also took in $800 of deposits and issued $150 of debt. All right. The total of $1,000 was put to use in 3 ways. These are listed on the left side of the balance sheet, which shows the bank's assets. The bank holds $200 in reserves. It made $700 in bank loans, and it used $100 to buy stocks and bonds, such as government or corporate bonds. All right, the bank decides how to allocate its resources among asset classes based on their risk and return, as well as on any regulations, such as reserve requirements, that restrict the bank's choices. By the rules of accounting, the reserves, loans, and securities on the left side must always equal in total the deposits, debt, and capital on the right side of the balance sheet. There's no magic in this equality. It occurs because the value of the owner's equity is by definition the value of the bank's assets, reserves, loans, and securities, minus the value of its liabilities. All right? So assets minus liabilities, what is taken in minus what it owes, is the owner's equity, basically the profit to the owners, the owner's equity. All right? Therefore, the left and right hand sides of the balance sheet always sum to the same total. Many businesses in the economy rely on leverage, the use of borrowed money, to supplement existing funds for investment purposes. Indeed, whenever anyone uses debt to finance an investment project, he's applying leverage. Leverage is particularly important for banks because borrowing and lending are at the heart of what they do. To fully understand banking is crucial to understand how leverage works. The leverage ratio is the ratio of a bank's total assets to bank capital. In this example, the leverage ratio is 1,000 to 50, or 20. $1,000 of assets to $50 of owner's equity, or 20. A leverage ratio of 20 means that for every dollar of capital that the bank owners have contributed, the bank has $20 of assets. Of the $20 of assets, 19 are financed with borrowed money, either by taking in deposits or issuing debt. You may have learned in a science class that a lever can amplify a force. A boulder that you cannot move with your arms alone will move more easily if you use a lever. A similar result occurs with bank leverage. To see how this works, let's continue with this numerical example. Suppose that the bank's assets were to rise in value by 5% because, say, some of the securities the bank was holding rose in price. then the $1,000 of assets would now be worth $1,050. Because the depositors and debt holders are still owed $950, the bank capital rises from 50 to 100. So when the leverage rate is 20, a 5% increase in the value of assets increases the owner's equity by 100%. The same principle works on the downside, but with troubling consequences. Suppose that some people who borrowed from the bank default on their loans, reducing the value of the bank's assets by 5%. Because the depositors and debt holders have the legal right to be paid before the bank owners, the value of the owner's equity falls to 0. So the value of their assets decreases by 5%, the value of the owner's equity falls by 100%. Thus, when the leverage ratio is 20, a 5% fall in the value of the bank assets leads to a 100% fall in bank capital. If the value of assets were to fall by more than 5%, the bank's assets would fall below its liabilities. In this case, the bank would be insolvent and it would be unable to pay off its debt holders and depositors in full. Bank regulators require banks to hold a certain amount of capital. The goal of such a capital requirement is to ensure that banks will be able to pay off their depositors without having to resort to government-provided deposit insurance funds. The amount of capital required depends on the kinds of assets a bank holds. If the bank holds safe assets, such as government bonds, regulators require less capital than if the bank holds risky assets, such as loans to borrowers whose credit is not that good. In 2008 and 2009, many banks found themselves with too little capital after they incurred losses on some of their assets, specifically mortgage loans and securities backed by mortgage loans. The shortage of capital induced the banks to reduce their lending, a phenomenon sometimes called a credit crunch, which in turn contributed to a severe downturn in economic activity. To address the problem, the U.S. Treasury, working together with the Federal Reserve, put billions of dollars of public funds into the banking system to increase the amount of bank capital. As a result, it temporarily made the U.S. taxpayer a part owner of many banks. The goal of this unusual policy was to recapitalize the banking system so that bank lending could return to a more normal level, which did occur by late 2009. All right, let's watch this other video now, which we will understand a little bit more. All right, let's see. Okay, let's do this. Oh, hold on. Okay.
By looking at the movie Despicable Me.
Hello, everybody.
Oops, sorry.
All right. Simmer down.
Monetary policy is when a central bank or other regulatory agency changes the money supply to achieve specific economic objectives. Actually, it's not that complicated. The first thing that you need to know to understand monetary policy is the role of banks and bankers in the economy. Banks are financial institutions that link borrowers with lenders, and although sometimes they're perceived as evil, they're absolutely essential to the health of the economy. People with extra money deposit that savings in banks, and the bank turns around and loans that money out to businesses and individuals that need to buy something expensive. Before giving that loan, the bank analyzes the risk involved to make sure they get paid back.
You have the audacity to ask the bank for money. You have any idea of the capital that this bank has invested in your crew? How can I put it? Let's say this apple is you. If we don't start getting our money back.
The bank also charges an interest rate, which is basically the price of borrowing money. The lower the interest rate, the cheaper the loan and the easier it is to pay back. The higher the interest rate, the more expensive the loan and the more difficult it is to pay it back. Wait, stop right there, that's it. This scene with the pillars shows the relationship between interest rates and the overall economy. If the interest rate is really high, then less people are going to take out loans because they don't want to be crushed by that giant interest rate. Consumer spending on big ticket items is going to decrease, and so the GDP is going to fall. But if interest rates are really low, the consumers can go and buy things like cars. The lower the rate, the more they can afford. So interest rates affect consumer spending, but they also affect business spending in the form of investment. Remember, investment is when companies buy machines, tools, factories to produce more stuff. If interest rates are really high and loans become more expensive, then companies are going to invest less and produce less and possibly even go out of business.
The bank is no longer funding us. In terms of money, we have no money.
And if a lot of companies go out of business, that could cause a recession and a whole lot of unemployment.
Now would probably be a good time to look for other employment options.
So lending and interest rates affect the entire economy. But what affects interest rates? Well, the answer is the money supply. But who controls the money supply? The Federal Reserve is the central bank of the United States, and it's ran by Janet Yellen. It regulates banks and controls the money supply. Change the money supply affects interest rates, which can affect the entire economy. That's called monetary policy. A committee of bankers chaired by Janet Yellen set target interest rates that signal the health and overall direction of the economy.
An increase in the target range for the federal funds rate remains unlikely at our next meeting in April. But an increase in the target range could be warranted at subsequent meetings.
There's two types of monetary policy. Expansionary monetary policy is when the Fed increases the money supply and puts more money in the system. This makes it easier for banks to loan out money, so it lowers the interest rates. That'll increase consumer spending and business spending, which will increase the GDP and expand the economy. Contractionary monetary policy is when the Fed decreases the money supply, causing interest rates to go up. That'll decrease consumer spending and investment spending and slow down the overall economy. Now, the goal isn't to ruin the economy and cause unemployment. The goal is to fight inflation. In fact, some people say that inflation is the Fed's nemesis. Now, normally spending is a good thing, but if there's a whole lot of spending and we're not producing more stuff, then we're going to get higher prices. In that case, the Fed uses contractionary monetary policy to decrease the money supply, raise interest rates, and slow down the entire economy to fight inflation. It's like the Fed's private shrink ray. Actually, a Fed chairman many years ago joked the main job of the Fed is to take away the punch bowl once the party gets started. Some economists think the government shouldn't get involved in the overall economy, but other economists think that some fine-tuning done by the Fed actually prevents some of the ups and the downs of the business cycle. Many economists think that economic calamities like the 2008 financial crisis would have been a whole lot worse if the Fed didn't step in. Now, either way, monetary policy along with fiscal policy are the two main weapons that the government uses to fight high unemployment and high inflation. Whether some banks are too big to fail or whether we need more banking regulation, one thing's for certain. We need an effective way to make sure that worthy borrowers can buy things like homes or expand their business.
I really don't see how we can afford this.
Hey, chillax. I'll just get another loan from the bank. They love me.